it's Bob Hoopsher, and this is the Gaining Perspective podcast where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Verify. The relatively new category of buffered or defined outcome ETFs has grown to $30 billion in assets, with more than $10 billion in inflows in 2023 alone. Amid significant uncertainty surrounding the Fed's trajectory for rate cuts, geopolitical tensions, and a presidential election year, investors are seeking new ways to mitigate risk in their portfolio while still participating in the returns of the equity market. Allianz entered the ETF market in 2020 to address this need with a growing suite of buffered ETFs. Buffered ETFs are a powerful tool for advisors and their clients to reduce volatility and diversify a traditional allocation. My guest today is Johan Gran. He is head ETF market strategist at Allianz Investment Management. Johan, let's start by having you tell me about your career path, what led you to Allianz, and your role there.
Yes, hi Bob. I appreciate that, and thank you first of all for having me on your podcast. I've been looking forward to chatting with you. So I'll try to keep the background relatively short, but just to give some context for what I'm also here to talk about, as it relates to buffered ETFs, because it is near and dear to my heart and something that I think is really quite valuable in many different ways in different portfolios. And if I think back to my own career and how I ended up in this place, I've been very fortunate, I must say. After college here, and by the way, my accent is Swedish. I'm from Sweden, so we get that out of the way. If I say something funny, it's okay if you laugh, Bob. I won't mind. But I've been very fortunate. I went to college in the United States, and I had the privilege of working for the University Endowment Fund back many years ago now. And I was trained by what is one of the largest institutional investment management consulting firms in the country back then. So I got to learn quite a bit during my first, 4 or 5 years in this industry. And fast forward just a little bit, and it was kind of a logical next step to just join one of these consulting firms so that I could help other endowments and foundations and pension funds to help them develop their own investment programs and manage their portfolios across all kinds of different asset classes, both liquid and illiquid asset classes. So another really good lens into how things are done in different firms and different parts of the industry. And that experience also led me then to take a job. I had an opportunity to work for a large insurance company headquartered, out of New York. And I had an opportunity to work with some of the best asset managers in the world, frankly, to build out a specific portfolio lineup that focused on risk management primarily, but then on multi-asset class allocation, diversification, etc. As well. And it was pretty complex. We developed portfolios that would invest globally. Some of them were incorporating volatility management. Some of them were momentum based. We had risk parity strategies, rate overlays, and the list goes on. So it was really rewarding to build and manage out this team around this effort. And we ended up growing that with the help of the broader company to about 35 billion in AUM before I exited for another opportunity to again build something fun. I was asked by Allianz that presented me with this opportunity to run a small and innovative entrepreneurial team inside of this large organization that has an incredibly strong global brand name. So obviously I found that very intriguing, and I've been wearing a few different hats along the way. But to make a very long story short, this is how we ended up developing the ETF business at Allianz here, based out of Minneapolis, Minnesota. And I've been focused on growing it. I know you mentioned we launched it in 2020. It was actually in June of 2020 during the worst part of the pandemic. So it was quite interesting time to get out to the market. But anyway, so I've been focused mostly on growing the business since then. And we just recently crossed 2 billion in AUM.
Great. Yes. Well, I did realize that defined outcome ETFs were launched during the pandemic, but they, to a large degree, I think, showed their value in 2022 when we had double-digit declines in the equity and fixed income markets. But the outstanding outperformer, given their structure, were defined outcome ETFs. So Allianz has a reputation as a global insurance company. What was the history behind its decision to enter the ETF market?
Yeah, sure. I mean, like any big organization, there comes a time when you start thinking about diversifying revenue streams and looking for new opportunities. And I was asked by the chief investment officer to do just that, to find a way to expand the business model and build off the core that we have. Looked at a long list of different opportunities, and frankly, it was. I wish I had a better story, but after exploring, quite a few of them, um, I had a industry friend of mine reach out to me and said he got eyes on a ETF filing in 2018, and I took a look at it and I knew right away what we needed to do. So, again, to make that long story short, I got to build out and work with this fully dedicated team. We were working day and night, and I had a supportive chain of command up to the executive chain, and ultimately we ended up launching an ETF business with buffered ETFs, and that's the short story for you, Bob, right there.
So tell me, for those who are not familiar with the product, what are buffered ETFs? What are they designed to do? How do they work? And how do they track and index? And specifically, since I know a little bit more about these than maybe the average person does, talk about whether they track and index, including dividends or without dividends.
Yeah, sure. So, okay, so there's a lot there. Maybe starting with the simple terms, buffered ETFs, I would say, I mean, they're designed in its isolation, if you will. They're designed for advisors and investors that are willing to give up some of those equity returns that most of their clients really don't need in order to avoid some of the losses that they really can't afford. So that's a very, I understand that is at 30,000 feet. Um, in many cases, it's for clients that they've made their money and now they're focusing on winning by not losing, or at least by losing less, without giving up all the upside potential that the equity markets can provide. So it's basically a way to avoid having to go into bonds or cash as you're becoming more conservative with your investments over time. It's also a way to avoid complexities that are associated with more alternative investment strategies, perhaps. But very practically speaking, just to get to the point or the meat of the question here, our buffer ETFs, they provide exposure to the S&P 500. And to your point about dividend included or not, no, these are price return index exposure. So what that means in our case, we have a couple of different variations of our buffer ETFs. We have one with a 10% buffer and one with a 20% buffer. Both of those have 12-month outcome periods, and I can get into that a little bit later if you like how that works. And we also have a 10% buffer with a 6-month outcome period for investors that are looking for shorter term outcome periods. But basically what it means is that if you're investing on day one in one of these ETFs, and let's just say that you have a 20% buffer, the S&P 500, or we're tracking the SPY more specifically, would have to go down by 20% or more before you start losing money in that account. So if you're investing, you mentioned 2022, it's a great example. I appreciate you cherry picking that one for me. If you invested in our 20% buffer on day one in 2022, $1 million, let's say, and the market was down, give or take 20%, you would have still had your $1 million at the end of 2022. So that's in very simple terms. And of course, we can come back to why that's really relevant when you're thinking about portfolio construction and so on and so forth, and diversification. But that's kind of how it works. And then, of course, nothing's free, right? So if you're going to protect some of that downside with a buffer, there is a limit in terms of how much you can make on the upside. So the most recent caps, refer to them as caps in terms of how much you can make in any given time period on our funds. The 20% buffer at the start of this year came with a cap of 12%. Our 10% buffer that would be in place for the year of 2024 came with a cap of almost 17% gross of fees. So as you can imagine, Bob, I mean, a lot of investors, they look at that and they say, look, if I don't have to take the first 20% of losses if the market goes down, and by the way, it's pretty rare that it goes down by more than 20%. So you feel pretty good when you go into this investment. but you can only make, quote, only make about 12% if the market goes up. For most investors, that's a pretty good trade-off. But as you know, it depends on what you're trading it for. So you got to sell something to buy something. So that begs the other question: where does the money come from? And we can obviously get into that too.
So if I were to think of this in simplistic terms, basically you own an S&P index and you've sold some call options, you've bought some put options to give yourself a collar around that index. You're going to get the index return on a price only basis, but you've got a cap that limits the upside and a buffer that limits the downside.
Yeah, it's relatively close, relatively close. So yeah, it's a put spread at the bottom, and then it's funded with by selling a call, and the call sets the cap. To your point, and we're using, this is a little bit too far in the weeds perhaps, but we're using flex options that are backed by the OCC, so we don't have a counterparty risk in the trading here, and we use flex options specifically so that we can specify the exact profile that we're looking for, so that we can have a very large amount of confidence in those buffers being sustained throughout the period that you're investing.
So I'm wondering, there's criticism. These are, to some extent, similar to other option-based strategies where people just sell call options against an index to generate extra income. And one of the criticisms that has been levied against those types of products is that you're basically converting a capital gain to ordinary income by giving up upside that would normally be a capital gain and converting it to income in the form of premiums from options that have been sold. Is that applicable to buffered ETFs, to defined outcome ETFs? Or is there a trade off here between long term capital gains and ordinary income?
Yeah, so maybe to clarify that a little bit. So the way that they're structured, there's no capital gains coming in. So there's nothing that's being there's no capital gains that are taxable. We're not generating any income by design. I should also mention the whole point of the structure is to provide, a 10 or a 20% buffer against market declines. So it's like risk management first, and then second is, well, based on the market pricing, how much can we possibly get after we've paid for that level of protection in the portfolio? And that is ultimately what determines the cap. So it's not a call writing strategy the way that many advisors or investors might be thinking about options based strategies. These are pure structures. So for advisors that are more accustomed to structure notes, it's easier to think about a structure note and then think about what that might look like in a liquid wrapper, like an ETF executed through the options market. So it sounds maybe more complicated than what it is, but we have, as an organization, we've been managing options for many years, decades, frankly, and we've built our trading capabilities around risk management, and we have billions of dollars in notional options trading value going through our desk every day, and it's literally in the trillions on an annual basis. So it's the company's bread and butter. We're just taking it and we're packaging it into an ETF so that as an investor you don't have to do it on your own.
Well, thank you for that clarification and for helping me learn a little bit more about this product. The buffered ETF category has grown to 30 billion, as I mentioned in my introduction. Uh, I'm sure that the 2022 market led to some growth, but what else has contributed to the significant growth in this sector of the ETF market?
Yeah, I mean, maybe I'm actually surprised it's not bigger, Bob, if I'm going to be honest with you. There is a bit of a adoption curve going on here. You have some early adopters and some that will take their time, and people will watch and see what's happening, right? But it's really fascinating. In 2022 that you mentioned, that market, the defined outcome ETF market, the broader buffer market, if you will, grew by about 10 billion. And that was, to your point, when the markets were plummeting, people were nervous, it looked really, really bad. typically when you see assets come into risk management type of strategies, like you would argue that the buffer ETF is. No surprise there. But in 2023, the market grew by another 10 billion. And that was in a rallying market, as you know, when investors tend to be a little bit more, excited about the upswing and think perhaps a little bit less about risk management. So that tells you that you have a broadening out of the market acceptance, and you also see existing advisors and their clients using and getting accustomed to how these buffered ETF products work, investing more and allocating more to these types of strategies. So we're still in the, call it the relatively early innings. Many advisors and their clients haven't heard about buffered ETFs yet. And the educational aspects, and to my point earlier, a lot of what I spend my time on is trying to get that education out there. I try to talk to clients and make sure that there is a better understanding for how these products work. And it's a new asset class, so it should take some time for acceptance. And that's also not strange. I mean, anyone who went to go take an investment class a few years ago, there was nothing written about buffered ETFs, not a word. And if you study for a certification with call it a stack of 2 feet of textbooks, there were still no mention of buffered ETFs. So those things will have to kind of work their way into the system, if you will. And as people read about this and learn about this, this is basically becoming a liquid way of investing that didn't really exist before.
How are you seeing advisors incorporate buffered defined outcome products into client portfolios?
Right. So there are a few basic use cases. So one is to think about de-risking equity. That's a pretty straightforward approach. You have portfolios, you're trying to make them a little bit more conservative as your risk appetite decreases, and you have to make a choice as to whether you move typically assets from equities into something different. And this gives you one more opportunity to maintain exposure to the equity risk premia, but you put a buffer underneath of that exposure. The other way to think about this is the flip side is to up risk, lower yielding asset classes or assets that you, for one reason or another, would feel have a lower expected return going forward. That could be fixed income, or it could be real estate. Could pick your poison, if you will. So you can allocate from those assets into a buffered ETF to again come closer to the equity risk premia and still have lower volatility relative to just going all in long only. There are two more straightforward use cases. The third one would be to replace some of the complexity that a lot of investors have in what they call the alternatives allocation. So many times you see alternative investments, they're there to help provide diversification benefits in a portfolio, but it can get pretty complicated and cumbersome, and it doesn't always work. So we see a decent use case for a transition out of alternatives into something that is quote unquote an alternative because it's producing very different types of diversification benefits, but still with a cleaner type of implementation. The fourth one would be for cash. We see a lot of, as you know, a lot of cash that used to be on the sidelines, and now a lot of money that's going into cash-like investments because of the rate market where it is. But for the cash that's on the sideline because it's having a hard time deciding where it should be going, worried about the equity market, worried about the fixed income market, doesn't want to make it complicated. A buffer with a buffer ETF with a 20% downside risk mitigation is a pretty attractive option. The final thing I will say, and I know I'm being a little bit long-winded here, Bob, so bear with me, but if you take it one more layer down or up, I should say, in terms of sophistication, where it gets really interesting is when you're starting to manage portfolios actively, and you're managing towards a benchmark, and you want to overweight equities. Well, you can do that. You just sell something and buy more equities. But if the market goes against you, you're automatically generating negative alpha against the benchmark. So it's a true bet. If you're investing instead in a buffered ETF with, call it a 10% buffer, and you have 17, 18% upside, if you're wrong, you can be wrong for as long as the market is down by no more than 10%, and you still look good because you're not generating negative alpha. So you're tilting the odds in your favor. And the same is true on the downside. If you want to take a bearish bet and get out of the equity market, the same principle applies. So those, and then there's a whole bunch of different use cases that you can think about when you get more tactical and more opportunistic when you're trading these ETFs. It's really quite fascinating, frankly.
Thank you. Why would an investor consider a buffered ETF for downside mitigation as opposed to, say, more traditional options on the market, simply a portfolio of stocks and bonds, a portfolio of stocks and T-bills? T-bills now yield 5% or more. So why choose buffered ETFs over that strategy?
Diversification benefits, in which comes from correlation benefits. And there's a big difference between, I call it the hopeful diversification benefits, from traditional asset allocation, um, where you hope that things are going to work the way you want them to, based on how you built your portfolio. Doesn't always happen. I don't mean to beat up on 2022, but it's the prime example. Outlier, yes, but when bonds and equities are selling off at the same time, there's not a lot of confidence in the correlation benefits at all. So if you want to build confidence into your portfolio in terms of what you can expect, again, buffer ETF can be pretty interesting because when markets sell off, the more they sell off, the closer that allocation to the buffer ETF goes to zero. So in other words, once you come down into that buffer zone, it moves very little, even if the markets keep tanking. And again, use 2022 because it's a simple example. And I'll also make the point here for why this is relevant, when you're looking to win more by losing less. I'm going to use 2022 and 2023 as examples, and I'm going to try to go through this relatively quickly here. But 2022, market was down 20%. A buffered ETF with a 20% buffer, down zero, gross of fees. 2023, so you have $1 million left in one portfolio. You have $800,000 left in the one that was just pure S&P 500. In 2023, the flip side happens. The market is up by 25, 26%. Well, you're capped out at 15% in the buffer portfolio. You're not capped out in the S&P 500 portfolio, but you still have $150,000 more theoretically in your buffer portfolio than in the pure S&P 500 portfolio. So the math works out. You can double check it if you like, but that's part of the benefit of doing this, right? You lose less, you have less of a hole to dig out of, and you can still participate when the markets turn around.
So the S&P was up about 26% last year. There was a record 1.34 trillion of flows that went into money market funds. Many of those funds are have been and still are yielding in the 5% range. How can investors more confidently put their cash to work?
Well, I guess it depends on the motivation for that cash investment. But if you just want to hold cash, then there's nothing wrong with that. But if you're expecting to get 5% out of your cash forever, then you're probably not making the best decision. Cash is cash, and that can change the second the Federal Reserve decides to make a move, and it will change when they do, right? So that's the known factor. But in the meantime, it looks pretty good, keeping in mind that it's annualized, and you also pay taxes on the income and so on and so forth. But all that aside, I think it's the it if you're in cash and you're looking for yield or return, then you know that music is going to fade and stop at some point. Today it's nice, you get your 5%, and that's great. Won't always be the case. If you want to fast forward and look to be positioned for when equity markets come back, or continue going, or if you want to have equity market exposure, then it's, again, I keep coming back to the 20% buffer because it has that nice trade-off between risk and reward potential. But it is not cash, to be clear.
So you've mentioned a little bit about the Allianz products and their caps and their floors, but give me more of an overview of the Allianz suite of defined outcome products, and particularly how do they differ from others that are in the market? I've had other guests here on this podcast that have talked about defined outcome products. And importantly, what is the expense ratio on your funds?
Yeah, sure. I know I mentioned earlier, we do this in house, right? We've built out the capabilities to manage these types of products in house, and we've done that for a couple of decades now. And I don't say that lightly. As I mentioned, we trade billions every day in these type of product in options based products. So we have the experts. We have some of the smartest people in the industry right here in our building, and that means our traders and our portfolio managers. They can stay at the front lines of the ETF ecosystem. They have daily connectivity with market makers and authorized participants, and so on and so forth. So it just gives us more control over that part of the ecosystem. And since we're doing it in house, we can control how we control. We don't have to outsource these functions, which gives us a better cost control. And so with that, we have, as I'm sure you're aware, we have three dominant buffer ETF issuers in the market, and we're offering the lowest expense ratio at 74 basis points. Um, um, and That's largely driven by the fact that we're doing all these things in house. And then for the lineup, we've intentionally kept it straightforward. So we have the 10% buffer over 12 months or 6 months, and we have a 20% buffer over 12 months. And we find it's by design, by the way. We found it to be paramount to avoid complexities in this emerging field. And it also helps to set the expectations appropriately, and it helps to build trust, and it doesn't overly complicate things. And in terms of product differentiation, we're the only firm right now that offers a buffer with a 6-month outcome period. So what that means is that the cap resets every 6 months, but importantly, it doesn't mature, so it doesn't trigger any taxable events. You can hold it for as long as you want, just like any other ETF. And the same is true for the other ETFs that we have with 12-month outcome periods. You can hold them as long as you want, and you don't trigger taxes until you sell them if they're in a gain position. And then, of course, we're rolling out a few new strategies, in 2024 as well.
Well, we will look forward to seeing what those strategies are. If there's one key takeaway that you'd like to leave with our audience of advisors about how they should evaluate buffered or defined outcome products, what would that be?
I would say, like most things when it comes to investing, do your homework on the products, learn how they work, but with the caveat of not overthinking it. When the deeper you go, like everything else, the more you learn, the more complicated things can be. But the original thesis is pretty straightforward. So if you appreciate the idea of having a buffer underneath your equity investing with a capped upside, then that's a good starting point. And then the details can be ironed out, and we obviously have plenty of people around to help discuss and talk about how these things work in the very fine details, if that's something that's of interest, right? But the point is that these are strategies that they don't have any like hidden gimmicks, and what you see is what you get, basically. And there should be no need for negative surprises as long as you know what you're getting into. And to help with that, we have a pretty straightforward product table on our website that anyone can go to, and you can always see exactly where our ETFs are trading in relation to where the cap and the buffer is. So you always know what you can expect from it when you're buying it, and you always know where you're selling it because that is the price at that time, right? So it's transparent, but do your homework like always.
Well, thank you. And to aid in that homework, we're going to include some links in the notes that accompany this podcast where you'll be able to get more information about Johan and his team and the Allianz product line. There'll be a link to the Allianz website, a link to Allianz's buffered ETF resource, and a link to the Allianz Q4 market participation or market perception study. Johan, is there anything else you'd like to add?
Well, Bob, it's been a pleasure. That's I definitely want to mention that. It's been great talking to you, Bob, and I want to thank Advisor Perspectives and Verify. I've talked to many of the folks over there on multiple occasions, and it's always a pleasure. So thank you so much for doing this.
You're welcome, and thank you for listening to the Gaining Perspective podcast with Bob Hoopshire. Today featuring Johan Gran of Allianz Investment Management. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.